The much anticipated signs of a cooling US job market have finally arrived, providing concrete evidence to those who have long predicted such a downturn. In October, the US labor market added just 150,000 jobs, with the unemployment rate rising to a 21-month high. At the same time, wage growth decelerated to a significantly lower level than expected, reinforcing investors' belief that the era of rate hikes is over. And this resulted in the US dollar rapidly losing ground across the market spectrum. The US dollar index, which measures its strength against the basket of 6 major currencies, dropped to its lowest level in 6 months. The quote slid below 105.30, posting losses over 1.3%. On Wednesday, the US Federal Reserve left its key interest rate unchanged, with Powell given a hint that there was no point in additional rate increases this year, and this statement caused a sell-off in the US dollar. In the US bond market also saw some downturn as yield began to drop. Thus, the 10-year Treasury yields hit a 3-week low, signaling a shift in investor sentiment. Meanwhile, the euro buyers benefited from a weakening US dollar. By the end of the last trading week, the euro appreciated by 1.5% against the greenback, climbing back above the 1.07 level for the first time since September. The move happened even despite the European Central Bank signaling a pause in further rate hikes. Although inflation in the Eurozone has slowed sharply, which is a positive sign, business activity is still low, tempering optimism about the outlook for Europe's economy. The GDP of the Eurozone and Germany contracted by 0.1% in the third quarter, bringing back recession risks. For your reference, a recession is declared with the GDP declines for the 2 consecutive quarters. The British pound also faced a strong buying interest, propelling the pound to a 1.5 months high of 1.2380 against the dollar. Investors took note of the Bank of England's decision to refrain from another rate hike. On Thursday, UK policymakers kept the rate steady at a 15-year high of 5.25%. However, unlike its peers, a significant factor within the Bank of England continues to vote for further rate increases. Nonetheless, the British Central Bank also warned that the UK's economic prospects remain highly uncertain, with a recent forecast suggesting that the economy had stagnated in the third quarter. In the meantime, the yen traders were testing the patience of the Bank of Japan throughout the whole previous week. The Japanese currency is hovering near the critical level of 150 yen against the dollar, its weakest position since 1990, despite a general retreat in the US dollar. The yen failed to reclaim lost ground. Among major currencies, the yen saw the least appreciation last week as investors factored in the Japanese monetary authority's intention to maintain a negative interest rate policy until inflation consistently hits the 2% target. Gold is trading at a 5-month high, and this time its advance is attributed to the policy stance of the US Federal Reserve rather than geopolitical tensions. However, the precious metal saw a nearly 0.5% decrease in value by the end of the week. The situation in the Middle East appears to be stabilizing, reducing the impact on gold prices compared to the previous periods of heightened tension. Brent crude oil also adjusted its course, dropping by 5% to $85.25 per barrel over the last week, a level last seen when Hamas launched attacks on Israel. Oil traders are hopeful that the Israeli-Palestinian conflict will not escalate further and won't affect oil supplies from the region. Meanwhile, business activity data published last week recorded a continuation of a fall in energy consumption due to the ongoing economic downturn, further exerting downward pressure on oil prices. You have watched Combat Review of a currency and commodity markets on the InstaForex TV channel. We wish you profitable trading and waiting for you on our channel with a new video.